Okay. Katie's letting everybody in.
Okay.
Good morning, Kim.
Hello.
I'll monitor this too. Welcome, welcome. Hey, John, how are you?
Morning.
Good morning.
Good morning.
People are showing up hot and heavy.
All right.
All right. Morning, everybody.
Morning.
Let's get started because we've got this planned for an hour. I'm going to be respectful of everybody's time. Welcome to EO Insight Hour with EO Philadelphia. This is our second edition of this new series that we've rebooted an old series with. And we are very fortunate today to have Steve Staugaitis with us. Steve, did I pronounce your name correctly there?
Sure did. Thanks.
All right. And Steve is, well, I'll let Steve introduce himself, but he's leads, I believe, the small business group at Kreischer Miller. And our topic today is big, yes, beautiful, still TBD. There's a new bill that's been passed and how it's all going to affect you. The 1BBB Act that was passed, One Big Beautiful Bill Act, has a lot in it. I got the chance to sit through a similar session with another group about 2 weeks ago. There's definitely a lot to know. There's a lot of moving parts, and so some of it can be a little bit dry because it's tax code. But let's make this a lively conversation. If you guys have questions, I'll let Steve kind of take the wheel, and I know he's got some stuff to present, and then hopefully we can have some discussion at the end and get some questions in. So ideally about 30 minutes of an overview, and then 15 minutes or so of questions, and 15 minutes or so of maybe some roundtable discussion at the end as to how you're utilizing this or what you might be planning with the information we learned today. So Steve, I'll turn it over to you if you want to share your screen. I believe you have the ability to do so, but if you need anything, just let me know.
I do. Thank you, Brian. And good morning, everyone. I promise I will try to make taxes as fun as possible in the context of things on a Friday morning. But as Brian mentioned, I'm Steve Staugaitis. I run our small business advisory practice here at Kreischer Miller. So our goal is really to work with sort of that smaller middle market segment of the business environment, with the goal of really being a nurturing ground for a lot of our clients. So we're working with companies on the smaller end that scale up to maybe 20 to maybe 30 million of revenue. But our goal is really to integrate some of the accounting, tax, and advisory services for those businesses. So I work a lot with closely held owners and a lot of family businesses as well. So I'm going to do a quick screen share just to help guide the conversation more than anything else here, to keep me on track. And just think, is that showing up for everybody?
Yep.
Okay.
Yep.
All right. Awesome.
That's good.
Awesome. Yeah. So I'm not going to go heavy. Legal disclaimer, as with taxes, it all depends, right? And so this is, some of the things we're talking about are more at the conceptual level, and don't necessarily constitute exact tax advice, because we would need to know the specific situations. But as far as what we're trying to just accomplish today in the next 20 minutes, just give a quick overview of some of the key provisions that are affecting privately owned businesses and the owners, and then really weave into what are some of the strategic planning opportunities. A lot of these things are items we're talking about with our clients. currently and certainly in the future here. So on the front end, what I like to say is this piece of legislation was 869 pages, so not a small piece of legislation. It wasn't all tax related. There was a handful of other things that are included in that bill, but we'll stick to our focus. Is primarily on what were some of those changes in the tax provisions. Broke it up into two pieces. One is, what are some of the things that were affecting a lot of our business owners? And then what are some things that are affecting the individual shareholders? And for many of you, if you are a business that has what's referred to as a pass-through election, right? There's a pretty big intertwine between how those two work together. How we look at it, when we look at what changes were related into the bill, I think they really fall into three main buckets, right? There were certain provisions that were set to expire at the end of 2025 that were just extended going forward. So not a new concept necessarily, but just an extension of some existing provisions. Then there was a handful of modifications to existing provisions, and so there was just some changes, some tweaks to how those rules were being applied, and then there's some new concepts that were introduced. As far as on the business side of things, one of the big things that was set to affect many of our clients was this concept called a qualified business income deduction. And so for any of you that are S corps, partnerships, LLCs, from just a legal organizational structure, you have been, assuming you have the qualifying business, right? You were eligible for this 20% deduction on that type of business income, and that was created to create a little bit of some parity with what was put into law under the 2018 Tax and Jobs Act or 16 of allowing C corporations to have a fixed rate of 21%. That was a permanent piece of legislation. This QBI, qualified business income, was introduced as a new concept back in the 2016 law and was set to expire at the end of this year. So that was an extension that was much needed for most of the businesses that were not organized as C corporations, which affects a vast majority of small businesses in the U.S. You can see there's a handful of modifications that were introduced. Certain things related to depreciation. A big driver for many of our businesses is, anytime they're buying, equipment, making some certain improvements to maybe some real estate that they own. They now have some incentives to be able to deduct those items more upfront rather than having to spread those expenses out over a period of time. Another really big one that affected many of our manufacturing clients or anybody doing any kind of research and development. If any of you were affected by it, that's I'll put it that way. But that is now eligible for those expenses to be deducted. There was a little piece of legislation that was sort of slipped into the 2016 Tax and Jobs Cut Act that said, starting in 2020, businesses that have research and development expenses need to capitalize those costs and deduct them over a 5-year or 15-year period, depending on whether it was domestic or foreign expenses. But and that caused a real pain point for many of our businesses because they were spending the cash today on those items, but the deduction was now being spread out over a 5-year period. So for many of our clients that were in manufacturing technology spaces were pretty negatively affected by that. So this is a very welcomed deduction, a reinstatement of something. A couple of other modifications that, we're starting to have some discussions with our clients relate to small business stock. I can get into that in a little bit, but for those businesses that are not organized as C corporations, there might be some, depending upon some of the motives of the owners, there may be some opportunities to rethink about should we be a C corporation. This was a little thing, but I do think it affects a lot of our businesses, 1099 reporting. So for those of you that pay any consultants, other people that are not, on a W-2 perspective, there was an increase in the cutoff for when you need to file and issue a 1099 starting in 2026. So that doesn't affect 2025, but in 2026, anybody that you paid more than $2,000 to needs a 1099 as opposed to $600, which was the previous limit. So that I think is just a welcomed administrative relief for many of our clients. A few things related to interest expense limitations. I don't know how much that affects any of you, but there were some limits on how much interest expense you could take at the business level. There was a tweak to the modification that makes the interest more deductible at this point. We didn't have too many clients that this really affected, at least not ones that I worked with. It probably affected more anybody in like a real estate development, any type of business line that had a heavy amount of like leverage on their books. And then obviously there's just from a commercial side of things, there's just an acceleration of a handful of energy credits and incentives. On the commercial side of things, those were accelerated to expire June of 2026. So anybody working on a commercial project, whether it was for solar or any type of other energy efficiency, there were some tax credits and deductions available for those projects. Those are now being accelerated to expire at June of 2026 for the business side of things. And then the other thing that's a new concept is this tip in overtime exemption from income. That's more of a tax savings for any individuals that are receiving that type of income. But as it relates to the businesses, it would impact any type of reporting that they're going to need to do starting this year. I think just based on our understanding, a lot of that reporting is going to be pushed back onto the payroll companies. So for any of you that are working with payroll companies, I'm sure if you haven't heard already, they will have solutions related to how they're going to carve out that reporting. For anybody handling it in-house, you will need to identify those items. In 2025, they don't have the box codes set up for it yet. So there is like an other box that we suspect companies are going to utilize that, or just attach a statement with the W-2s that are going out, breaking out any of that income on those two things. So those were probably the much bigger things related to businesses on that front. So,
Steve, what did you mention the employer meal deductibility? I think.
Oh, yeah, sorry. Yeah, and in employer meal deductibility, that was for companies that were providing meals to their employees. Those expenses are now will no longer be deductible starting in 2026. Prior to that, there was a minimum of a 50% deduction, and in some cases 100%. Now that will revert to being nothing. There'll be not a deduction. You can still do it, right? But you just won't get a tax deduction for it any longer. So we did that at our firm. We bring meals into our staff during like our busier times of the year. So that is we would be affected by that in our business. I don't think it's intended for the one-offs. If you have like a holiday party, I think those are still going to be considered deductible, but just a regular providing of meals will not be. So, yep. Then on the individual side, again, a handful of provisions that were extensions, modifications, and some new concepts. Probably the biggest things that were extended is the existing tax brackets, and there was actually inflation factors that were added to that. So we still have 7 brackets, but now they're getting a little bit wider, particularly at the 10 and 12% levels, which is, I think, going to be beneficial for individual taxpayers. And then the estate and gift exemption levels were a temporary provision that were set to expire and revert back to a lesser amount. Those were now extended. So that is now that remains at $15 million estate and lifetime gift exemption for each individual. So for married couples, that's $30 million worth of personal assets that will be exempt from any type of estate and gift. So I think for many of you that are business owners, right, that could be, to the extent your business makes up a portion of your significant portion of your wealth, any type of transaction related to that would under that 15 or 30 million would be exempt from estate taxes, which are fairly punitive when you go over that amount. Modifications have to do with a deductibility on charitable contributions. So there's now a floor concept that's being introduced starting in 2026. So charitable contributions would fall on your personal return. You get the greater of a standard deduction or the aggregate of a bunch of itemized deductions, right? So charitable contributions would fall on your itemized deduction side of things, but those are now subject to a 0.5% floor. So of your adjusted income there. So there will be a little haircut on charitable contributions starting in 2026. So again, some planning opportunities have to do with the timing of deductions on that front. There was some expansion and usage increases for 529 plans. So those are education savings vehicles that are available to taxpayers to aggregate some funds in a more tax efficient manner on that front. And I'll get into that from a strategy perspective, actually, Brian, a little bit. There's an itemized deduction phase out. So for taxpayers in the top tax bracket, there will be a limit on how much of those itemized deductions you would be eligible to take. So that would affect taxpayers in the 37% tax bracket. To give some context, your income on a joint level would need to be in excess of like 750,000 before that really starts to affect you. So there were some changes to enhance a little bit of some of the dependent and child care credits. I think that's a fairly welcomed change for families. Again, we saw just some acceleration of clean energy credits affecting individuals. The vehicles, like the clean energy vehicles, those expired September, so just a couple of weeks ago. So if you listen to the news, there was probably a mass purchase of any of those vehicles prior to that date. But there is now no longer clean vehicle tax credits available. And then any improvements to a residential property, those would be expire at the end of 2025, so the end of this year. So a couple months left on that front. And then the state and local tax deduction, that brought a lot of topic discussion for a lot of business owners and individuals, where if you itemize, right, there was one of those itemized deduction categories is state and local taxes. So what you would pay in income taxes to other states, your real estate taxes for your home, and like a vacation property that you may own. Those were capped at a $10,000 limit, has now increased to up to a $40,000 limit. And I just put some asterisks around some of the things that they do have phase outs, right? So it's on the state and local tax limits. The $40,000 applies if your income is under, I think, $500,000. If it's over that, then you'll get the maximum of 10. So there's a little bit of a phase out there. And then the new concepts, I think, which were introduced was for anybody age 65 or older for the next couple of years has a new $6,000 exemption, like off of their income. So it would be up to $12,000 for a married couple. Auto interest deduction was something that garnered a little bit of interest, a little bit of attention, that if you have auto vehicle interest, that will now be deductible, again, subject to some phase out limitations. And then the big new concept that was introduced was something called Trump accounts, which work a bit like what I say, like as a non-deductible IRA, if you will. So these accounts are available starting in 2026, where the government is going to jumpstart those accounts for any new births between 2025 to 2028. Will get an initial $1,000 contribution. So the concept behind this was it's intended for minors, right? For minors to accumulate dollars, and then when they turn 18, have access to some money available. The government is going to, like I said, jumpstart those accounts for the next few years, and then what individuals can contribute up to $5,000 a year to those accounts, and businesses can contribute up to $2,500 into those type of accounts. The dollars will grow tax deferred, but when the money comes out, there is an income hit to the individual, and the money would become available. And I don't know if it's a forced withdrawal or not when a child then turns 18. So how it's going to affect, I think, our clients and just discussions we're having, I think a lot of it depends on what the intended use of some of those dollars would be. If those dollars are intended to be for education type planning, I think the 529 seems to make a lot more sense, because when the money is taken out of a 529, if it's used for education, there's not a taxable event. Whereas if you accumulate dollars in a Trump account for education, and when the child turns 18 and the money's taken out for education, there's still a taxable event on all of those earnings. So, but I think if you look at maximizing all the other types of incentives, this might be one. I think the concept here was to allow either certain communities or municipalities that wanted, to drive some tax dollars into, their census of people, that they would have the ability to do something like that. So, but that is a fairly new concept there that was introduced. So, any questions on that or so far?
I think some of this they're still figuring out, as I understand. Is that correct? it's not all set in stone yet. Is that right?
For
Like the Trump accounts, especially, and then some of the. So
yeah,
I,
well,
Is there a phase
anything
out limit for the Trump accounts for kids?
there is not.
Okay.
There is not. What I think has probably held it up is, okay, we have this concept, but who is administering it, right? Like, where is this money going? My understanding is that the bigger brokerage houses are going to be the ones that are going to set up these initial accounts, and there's going to be some coordination, I think, between the Social Security Administration for the new births that are occurring. So for people that are obtaining Social Security numbers for their children, there'll have to be some coordination back with like a I don't know, a T. Rowe Price or a Charles Schwab. I don't know exactly who's been identified to administer it, but for the government to then direct that initial that funding of those accounts. But for if you have, let's say, an 8-year-old already, right? That's not a new birth, that wouldn't get that initial jump. You would still be able to set up an account and add some dollars to it. So, but the details of that have not been put forth yet. So, and then I just keeping Brian, I'm keeping a little bit of eye on some time here. Maybe the next 5 minutes, just touch upon a handful of some of the tax strategies or opportunities that we are seeing based on with our clients. If you look at charitable contributions, right? I mean, I think there's some strategies now to consider bunching deductions into 1 year as opposed to continuing to spread them out. This could also be dovetailed into the use of donor advised funds in order to do that. And there's always the ability for those in retirement to have direct contributions going from their IRA into directly to a charity. That is really helpful because it counts towards your required minimum distribution on that front. So I don't know how many people on this call that affects, but that is something that's available there. Again, the qualified small business stock is one that I think could be interesting to talk about with our clients. Generally speaking, the decision between setting a business up as a C corporation versus another type of organization had a lot to do with, we see a lot of businesses starting out as LLC, limited liability companies, LLCs, because they're really easy to set up. But C corporations, there's a little bit more on the front end to be a little more formality related to it. But the biggest hangup that affected most small businesses with the decision between the C and a pass-through entity really had to do with, well, what is the motives of the owners with the profits that they're generating from the business, right? Because in a C corp structure, there's a punitive double taxation for owners that are looking to extract those profits from the company, right? So in a C corporation, the profits are first taxed at the corporate level, but then when the distribution of the profits come out to the owners, it comes out in the form of a dividend. So think of, owning, shares in a publicly traded company. Almost a majority of those are set up as C corporations. If you receive a dividend from them, there's a taxation at the personal level. So it's fairly punitive from a tax perspective for owners that want to take profits from the company. Where it can work really well, though, is with business owners that are saying, like, look, my goals are to reinvest the profits back into the growth of this business, and I'm planning for like an exit strategy within a 3 to 5 year window time frame, right? And in those cases, there's a slightly lower tax burden, certainly at the federal level, for the profits being incurred, and there could be a really big benefit on the sale of that stock upon an exit event. So a couple of things, and I do have maybe while I'm talking about it, I'll just flip to that slide here. A few things that were in place and what they've increased to. So originally, we didn't see a lot of qualified small business stock because, as you can imagine, there was a fairly substantial benefit where you could exclude up to $10 million of a gain upon the sale of your stock. But with that benefit came a lot of restrictions. One of the big ones is you had to have a minimum holding period of 5 years. You had to be an original issuer of the stock. You have to be a qualifying business, right? That's a pretty big one. And then the size of the business mattered upon the exit. So if you had a company that grew too big, right, you might not benefit from that exclusion. So what came into law that makes it a little more interesting is that they increased the size that the company could grow to. So it's defined from an asset perspective. So think of your balance sheet, but a maximum assets of 50 is now, you can be as big as a $75 million worth of assets on your balance sheet. When you receive the stock, I should say, and the exclusion increased from 10 to 15 million.
I mean, I'm on this.
Yep. And the other big thing is the holding period is now a tiered structure. So 3, 4, or 5 years, as opposed to just 5 years. So, but to be a qualified small business, you have to be in a qualifying industry, which is generally geared a little bit more towards like industrial and some technology. What it does exclude is any like personal service type businesses. So businesses that rely on sort of the individual expertise of the people, like, and they sort of define it, think of like law firms, accounting firms, consultants, that sort of thing. They are not considered a qualified business, so they are excluded. But manufacturing, distribution, some technology type companies that are like on the software side, those would be considered qualified type businesses. So, but that is one that, again, motives I think matter a lot, and industry, certainly you got to just check the qualifying from an industry perspective. State tax planning, again, now with the increase in the state and local deduction is pretty helpful, and some residency planning. And then there was something called a pass-through entity tax election. I don't know how many of you that would have affected on the call, but if you have cross-state, commerce activities that had you filing in different states, there were some opportunities for you to pay the taxes at your business level rather than passing through to you, and getting some deductions at the company level, as opposed to having it pass through and be subject to this $10,000 limit at the individual level. So that is still available and something to think about. The research and development, there's now that those expenses are now eligible to be deducted, there's a handful of options that are available to you. If you are a small business, meaning under $31 million of revenue, you would have the opportunity to go back and amend prior year returns. But you also have the option to take a deduction in 25 or in 25 and 26 for any of these costs that have been capitalized. So that will have a lot to do with has my ownership changed substantially? Would I, am I eligible to amend, or do I have to do the carry forward deduction? And if I'm thinking I'm going to have some higher profits in 25 and or 26, I may want to just use this as an opportunity to offset some of those deductions there. So there's a little bit of some planning depending on facts and circumstances. Estate planning, always something to keep an eye on, especially for our businesses. It's there's certainly gifting opportunities, some establishment of some trusts that create a separate taxpayer that can be pretty important there. And then the 529 type planning, I will just jump to that slide. Brian, I will wrap up in a minute here. There was just some pretty big enhancements to how much you could use for K through 12 expenses. If there was a limit of 10, now you can use up to 20. This, I think, was a very welcomed change, is that the expansion of these expenses now extend to post-secondary credentialing, including vocational training, much needed skill in our country here, and also will address community college training centers and some other occupational or professional licensing. So I think that those are, the expansion of what those dollars can be used for is pretty welcomed, and just expanded just usage for either private schooling, homeschooling type dollars there. So. And then just, we talk a little bit about, there's a fair, I'll just leave it at with depreciation. There's a fair amount of incentives there. As you can imagine, the tax policy is often used to help drive greater, initiatives within our country. And there's always been the pretty robust opportunities related to depreciation to encourage people to buy equipment, because we need people to make equipment, right? And so that's been in place. There were a few provisions that were set to expire. They're reinstated. I will say for most of our clients, there's a lot of opportunities to take write-offs, if you will, on assets that they are buying. I usually at least like to have the discussion between how are they paying for those things, because you can end up with a little bit of whiplash if you are financing these acquisitions of equipment, taking the deduction today, but then I got to repay these, pay a note or a lease down over a period of time. And I'm not going to have some deductions to offset the cash flow going out. So we do see a little bit of some whiplash there for companies that we at least like to try to plan for on that front. So I'm going to stop there, Brian, to just allow. I know I'll turn off the fire hose and
It is a fire hose. I think my biggest takeaway from this is trust my professionals. There's so much to know. I think it's great to be aware of a lot of what's going on, and really there is a lot of strategic planning that can be done. But ultimately, unless you do this all day, every day, like you do, Steve, we as business owners, I would guess, miss a good portion of it. And it's a good plug to just say this is why we have accounting firms, right, who specialize in this. So we're fortunate to have Kreischer Miller, who knows this stuff, as a strategic partner for EO Philly. One thing that I took away from the discussion the other day, Steve, you were touching on a little bit, is the 529 savings plans for education, right? Mm-hmm. And somebody in the other discussion was saying, at least at the state level in Pennsylvania, you can put in today and pay out of it tomorrow and get, save essentially 3% from the state tax, without it needing to sit in there for a certain period of time. So I thought that was something that was interesting. It's state specific. That's Pennsylvania. I believe it does not work in New Jersey, if anybody's over there. But they're getting to that granularity of detail. 3% could be, significant savings for some people to be paying for kids' education.
Yeah, well, certainly look at it. It's a when I tax people, I used to say better than a sharp stick in the eye, right? So if you're going to put some money away, there's a little bit of some incentive there. One thing I sort of glazed over is if you pair a little bit of the 529s with the Secure Act, which was a separate act. There is an ability when I think of sort of some like multi-generational like wealth accumulation and some tax planning is unused 529 plans can be converted into Roth IRAs for those beneficiaries. And so that could be an important planning tool for, maybe it's parents or grandparents, right? That have some dollars. There's rules around that, right? I mean, the money has to be in the account for like a minimum of, I want to say 15 years, right? But if the account's been around for that long, you could overfund those 529s, use it for education, and your sort of target goal is to have 30,000 left over at the end of the day. That the beneficiary, so the child would be able to convert those dollars into a Roth IRA over a period of a few years. I think 4 years. I think you're limited to 7,500 conversion every year, but that could be a way to move some money from one generation down to another, give, a 22, 23-year-old a nice jump start of, 30,000 in a Roth IRA that's never going to be taxed to them.
Yeah,
at least now.
that's interesting. And that's new to me. So one of the other things I found interesting too was no tax on tips isn't really no tax on tips. It's a limited deduction on tax on tips. And it's reported, or it's a credit that's going to be taken by the person who receives the tips. And then, as you stated, the businesses are going to have to report the tips, and it just, to me, it all gets really confusing, and it's really kind of been mismarketed, but there is some benefit to it, I guess, at some stage. I don't know how many of our businesses are working with tips in that sense, but those were some of the things I found interesting. I want to open it up to the last 20 or so minutes that we have left. I see a couple people have come off mute. Anybody else have comments or questions or thoughts they want to share?
I will say you can get a deduction in the state of New Jersey if you do a New Jersey best plan, but you have to be under 200K in income. So just a little FYI for all my Jerseyans here.
There you go.
It's not if you're an EO, you most likely do not qualify. I would guess so. You were probably right, Brian.
I had a follow-up question on the restructuring that you had in there. What would be the reasoning of the 3, 4, or 5? What?
So you mean with the small business?
Why the different time frames, and what I didn't understand why the benefit of A, B, or C.
Yep. So under the old rules, qualified small business stock needed to be held. It was a 5-year minimum, or it was an all or nothing type time frame retirement in order to get the gain exclusion level. The change that was introduced, which is now currently in law, is if you hold the stock for at least 3 years, you don't get the full 100% deduction. You'll get a 60% gain exclusion. If you've held the stock for 4 years, it's an 80% exclusion, and if it's 5 or more years, then you have the 100% exclusion. So it's made it a little more appealing for somebody to think about. Hey, look, if my time frame might not be the 5 years, there's maybe something to be gained. If you're not already and have not been a C corporation, and how you receive those shares matters. There's, some coordination to look at some restructuring to start as a C corporation, get originally issued shares, and start that time frame. But you really make sure you're in the qualified business. That's something, having some discussions in the coming months with some clients that might be an opportunity. So I haven't worked through a restructuring one yet, but we will be partnering with our legal partners on that end to help make sure we do it properly.
Sure, completely understood. If you're doing this, then I'm going to take that offline. I was going into the rabbit hole there. It's not tax related. It was you're limiting yourself now to a stock sale.
Correct. Chris,
Okay.
that is exactly some of the discussion and a little bit of the trade-offs. What is really an unknown item here, and what I'm curious to see is how sort of buyers are going to respond to that, because
you're right where I'm at now. Okay, we could do a whole nother hour on that, but that was why I had the question mark in my head. But thank you for answering that.
Yeah, no, you're absolutely right. That would be an unintended consequence of going in the direction. That's why I think the motives matter, and who might be a buyer of the business will become an important piece. I have seen recently, just anecdotally, of some of our clients that have been looking to sell have been able to change the structure to a stock sale. It's increasing the due diligence, right? Certainly on the legal due diligence side of things. And okay, well, what is the buyer assuming from a liability perspective? So it might increase reps and warranties, or maybe a little bit of a, like an escrow amount in order to move in that direction. But we have seen some adaptability to that.
Yeah. Appreciate it. Thanks, Steve.
Yep, you're welcome.
Yeah, a lot of moving pieces. How many pages again did you say there was? 864?
869.
69.
Yeah.
Have you read it all?
I started to. I mean, I printed it out because I just couldn't do it on the screen. It was starting to bug my eyes out a little bit.
Can't imagine.
But like I said, it's not, it's not all just tax legislation that's in that law. There's a handful of other, changes and initiatives and other things that are being funded, changes to things that were being funded. So that is in there. So it's kind of weeding through those pages to get to the tax components to it.
And a point that was made the other day too is it all has to balance at some point, right? So all the new giveaways they're going to take from somewhere else, and they're giving back. But and I think that was my understanding of why there was provisions that were going to sunset from the 2016.
Yes,
that was all part of how they balanced it back then, and they looked at it and made some of those more permanent and extended some, and then included new stuff in it as well. So
correct. And that's where I think when you look at that legislation where there's funding changes to other programs in the government in order to help offset certainly any of the permanent changes, but that's why we also see a handful of things in this legislation that are not permanent necessarily, right? There's a handful of things like the what I say, like the age 65 exemption amount. That's just for a short window of time that's in there, and then that goes away and falls off. So and I'm sure there's math performed to figure out who's affected and how many, and in order to make that all balance. But yes, I think they have a 10-year. It's got to be like a 10-year. Nothing more than 10 years if it doesn't.
So do we have a debate with the last 10 minutes? Is this actually a beautiful bill? It's big. There's no question about it. But is it beautiful? What do you guys think? We'll put it out to the crowd.
Yeah, I mean, I don't. There's too many nuances of what business is for me to comment. The 529 expansion is nice, as well as the SALT deduction, but the 500K really.
Yeah, right. I'd probably say from the tax side of things, it's probably more advantageous for business owners and taxpayers, right? The other pieces in the bill, that's, there are trade-offs for all of that. So,
And a big, I remember a lot of chatter about reduction in healthcare benefit. Was there anything healthcare related in this? Because they were saying, oh, you're going to take healthcare away from elderly and this and that
well,
and the other. And
but that's a non-tax. That was a non-tax item. But that is part of, I think, what is in here and adjustments. I know. I was trying to find some of that ahead of time, but there's like adjustments for who qualifies for like SNAP funding, which is like food related things. And there was
so it's a social offset essentially, right? You care more about your own balance sheet and implications versus the greater good of society and who needs help. Right. And I think we covered today mainly how this affects us from the tax side. And it does seem to be beneficial from that side. But I think I would say maybe the debate out in the world is, are we actually making society better? Or are we just giving tax breaks to people who, don't necessarily need them, but want them, of course.
In my world,
right.
it's pretty rough because we have a lot of nonprofit clients.
Yeah.
It's like every other week they're calling us and having to cut or cancel services because of their cuts to their business, and they don't want to, but it's feed the homeless or have human resources. So it's an easy one to cut, even though they need it and want it. And then their demand is getting higher because of the government shutdown. People are needing more. So it's been rough for us this year. It's not been fun.
Yeah, I'm sorry to hear that, but that's important. It's important feedback to know, right? It's
Well, that and the tariffs, so many, and it's not even just the clients that manufacture, it's the clients that serve the clients that manufacture or whatever, or just buy and sell, So we had spent 2 years planning for growth, 2 years planning for significant growth so I can eventually exit. That was the point, to start this year and have a few years under our belt. And it started off, our plan was working, and then February, as soon as things started to hit, just went that.
Yeah.
Yep. So we're getting out of it, though. I mean, it's just we're having to change completely, and I'm assuming we're going to be dealing with this next year. So I have to plan that this is going to be life now, and so how do we move ahead with it?
Yeah, we saw so much pullback in the first half of the year, in particular, because of the wave of changes that were coming through, and most of our business owners that had either some tie-in to, government funding or contracts or whatever were sort of on edge about what was going to be affected or not. We had, if you were tied into certain aspects of the government, you were probably a little bit more insulated, right? Like anybody dealing on the defense side of things, this particular bill increased funding for certain areas in there. So at least of our business clients that were tied into that had a little bit less of an impact. But I did have some that had, were selling some supplies to government where their contracts were cut. And then I think the tariff thing, particularly the first half of the year, was just sending a lot of particularly our smaller clients. They don't have as many resources to dedicate a couple of people to just go focus and see what was going on. And I think more often than not, they were being more reactive to, oh shit, I just gotta tariff. I got a tariff bill that I wasn't expecting and didn't factor that into some of their pricing on the front end. They're being more reactive, whereas I think some of the larger businesses, right, had resources available, or they had buying power pressure to put something back on the suppliers, and that yeah. So
Yeah.
some of those other changes for sure, I think were disproportionately affecting the smaller like business world for sure. Because then you would see exemptions come in, everything's taxed, but except chips going into iPhones or something, right? All this, but so that became, a little bit of a whirlwind.
Yeah, and we have some tariff impact in my business. We actually did a price adjustment at the beginning of the year to correct ourselves to our value in the market, and then tariffs impact, hit on top. So we have not passed any tariff impact through to our clients like most people do. And now I'm looking at the impact and saying, if this is going to keep up, maybe we need to, at some point, but I didn't want to make 2 price adjustments in 4 months and then, have clients be saying, hey, what's going on over here? So it's affecting us, and I've sat in on some other talks about trade between Canada and Mexico, and how much things cross the border before the finished product even comes out. But sometimes some of the car manufacturing out of Mexico that's happening right across the border, parts have crossed the border 20 sometimes, going into the final product, and all that gets multiplied. Or the food source and supply and some of the stuff coming out of Canada is interesting. But that's like, I don't want to get too off topic. We've got a couple minutes left. Any other final questions or thoughts? And we'll make sure we end on time here in a couple minutes.
This was great, Stephen. Thank you. I appreciate you taking the time today.
You're welcome, Shane.
Yeah.
Perfect. All right. Well, thanks everybody for showing up. Hopefully we'll see a bunch of you guys tomorrow at the EO Axes and Art happening at, well, I should know this and be prepared, but down in Delco, it's in Broomall. And of course, all the events coming up are on eophiladelphia.com. So make sure they're on your calendar. We'll see you guys. Thanks for showing up today. This will be recorded and posted. And if you missed the first session that Griff did, that is posted now on our new landing page, which is live on eophiladelphia.com for EO Insight Hour. So you can go back and watch the recordings. Our next one will be coming up in November. It's the 3rd Friday of each month, the same time. We don't have a topic planned for that yet because we want these topics to be timely. So if anybody has anything timely they want to hear about, certainly open to suggestions, and we are going to be trying to figure out that topic in the next week or two to bring to you guys. So I will go ahead and end the recording. I know Katie's at a conference and she's saying thanks everybody for coming, but let me hit it stop.